I need some traction.
Hey folks, Lloyd Lobo here, co-founder at Boast AI and Traction. Today's Traction webinar is brought to you by Boast AI Launch Academy in partnership with Growth Blazers. We normally have a very international audience here, Mark. So folks, hit the everyone button and introduce yourself, your name, the company, what you do, and where you're tuning in from. I'm tuning in from Austin. As people know, after 10 years, I moved from the Bay Area, San Francisco Bay Area to Austin. Mark, where are you tuning in from?
Unfortunately, Boston. If you're not here, don't come here.
It's freezing,
It's so cold and it's a terrible month.
Awesome. You got already people from Lagos, people from New Zealand, from Costa Rica, Toronto, Bay Area. Mr. International Mark Roberge is in the house. Germany, Romania.
Nice.
Wow, this is a truly international audience. I think they're here to see Mr. International. So, Mark, you've had a phenomenal background. I think you need no introduction, right? But before we dive into all of this, your slides and everything else, Stage 2 Capital, Harvard professor, former CRO at HubSpot, super successful career in tech. You came to our first conference in Banff in 2014.
So long ago.
You made the trip there. And you know what's really funny is from that 2014 conference, most of the speakers went on to build multi-billion-dollar companies. Like Jeff Lawson was there.
Totally.
Postmates CEO
it was a great crew. Yeah, for sure.
And we got everyone to come all the way to Banff. Awesome. So give us your backstory. How did you get into technology? How did you meet the founders of HubSpot? How did you create this whole category and movement around marketing automation and inbound?
Yeah. I mean, I was an engineer. I was a mechanical engineer at school. And my first 2 years of my career, I was writing code. And then it was staff. This is like, some of you, I'm dating myself, like it was like 1999, right before the 2000 craziness. And entrepreneurship was not as accessible as it was the last 2 decades. And then when it started to blow up in a good way and then blow up in a bad way, I found myself into a startup and never looked back. And so I just dedicated my life to entrepreneurship at that moment. I was like, I got to get an MBA. So I went to MIT, where they're very focused on entrepreneurship, and that added to my quant background. And then sat next to Dharmesh at school, the co-founder of HubSpot, and just he kind of said, "Hey, will you help me with my startup?" Right. So I was a consultant, and he brought in Halligan as co-founder, and Halligan was like, "I like that we have you for 1 day a week, but I don't really need strategy advice. I just want you to sell." And that's how I got into sales. It was just like I was getting paid an hourly rate by Halligan and Dharmesh, and Halligan was like, "Why don't you go sell?" And bam, like 10 years later, we were ringing the bell on the New York Stock Exchange. So it sounded exciting. It was really stressful, but it was a crazy ride.
And then the valuation since that point has more than 10x, right?
Yeah, when we went public, it was at $1 billion, and it hit 40 billion actually last quarter. That was before the correction. I think it's gone down to 20 and up to 30. It's crazy, right? But yeah, it's done well.
And you know what? One thing you guys did, and this is a great story because you learned to sell. I'm an engineer, and everything I learned about go-to-market was from HubSpot. You guys built a phenomenal community around inbound. And when I started out of engineering, my first job was in product, but it's a startup. So when you're running product, you're also talking to customers, and you have to do product market and everything.
For sure.
And I started coming across HubSpot, and I started reading up everything, did the certifications. Everything I learned about go-to-market and marketing and events and community was from you guys. And so naturally now, when we have money or we've raised money, we can afford to pay for tools. HubSpot's the key tool in our stack, right? And I often tell people, if you build a community, you won't become a commodity. So you guys have done a great job. How did your role evolve from selling to then pretty much running sales there?
Yeah, I mean, you kind of have to have career ADHD, because if you're not reinventing yourself in a company like that, where you're 1 year you're one of 4 employees, the next year you're one of 50, and then 500, so I went from seller for like the first 6 months, sold the first 100 customers or whatever, to sales manager, like hiring and training and coaching those reps, to teaching, building out the sales management layer, and then teaching people to be directors and VPs and running and going international, right? So when I left, I think I had I was CRO and had like 500 people in the org. So you just have to kind of both be like in the day-to-day execution, but also thinking what is coming up 6 months from now. And what I found out through that journey was the bigger we got, the more important it was for me to know what was going to happen in 6 months. And probably the biggest asset I had there was a couple of years into the journey, I was introduced to John McMahon, who he made his career at PTC and then went off and did 5 other public companies as head of sales. And he's on the board at Snowflake and MongoDB. And he's just like, just a world-renowned sales coach, mentor, leader. And he really helped me to see like what was out 6 to 9 months when we were bigger. Because when you get bigger, it's like when you're like people going to 50 and you miss something, like, oh, I forgot to develop a sales manager. Great, you can kind of fix that in a couple of weeks. But like when you're, much bigger, and if you don't see something that's going to kill you in 6 months and deal with it, you're kind of cooked. Like you can't. It's very difficult to recover from that. So that it took some career ADHD to manage through that growth.
So one question I have before you dive into your slides, right? And everyone says this, even Reid Hoffman says this, the hardest thing a company faces en route to scaling, the leaders there or the early employees, is going from individual contributor to manager to then executive. How did you make that transition, or what were the key learnings or advice you have for the audience here who are making that? Like, how do you go from doing everything yourself to sort of hiring people to manage, to then managing the managers? What were 2 or 3 things you learned along that way?
Yeah, I mean, I can speak to like potholes that I see extremely common when people make that leap. I don't have that slide today in my deck, but there is a bunch of studies that show that the top salespeople on a sales team are the most likely to be promoted to sales manager. But there's actually a inverse correlation between the top salesperson and their success as a sales manager, right? You say, don't promote your best rep to manager. And why does that happen? It's because if you think about what a great rep does, right? Like great discovery, relationship building, like very selfish with their time, can be a little aggressive or pushy, like not in a not in a turnoff way, but they're like, they can move people along. And a lot of those skills don't translate to management. And what happens is a lot of times a new manager who used to control their destiny, when they got behind in a quarter, they would just work harder. What a new manager sometimes does, now that they're managing 6 people and their quota is those 6 people, when one of their people gets behind, they're like, hey, you know what we're going to do? Just get me on your demos. Let me do your demos for you. That's a huge mistake. Super rep. But it's what most new managers do. And it kills it for a bunch of reasons. Your rep gets lazy. Your rep is no longer accountable because you're doing their job for them. Your rep loses confidence because you can do it better than them. And you don't scale as a manager. So really, the number one important, there's 2 big things you do as a manager: hire and coach. You got to be a great hire and you got to be a great coach. And to be a good seller, you don't do either of those. So just very different jobs. Recruiting
and coaching. And you yourself got some great coaching by one of the biggest names in tech here. Awesome. Without further ado, take away the slides and let's roll.
All right. Awesome. And folks, you can see it, Lloyd? Right?
Yeah, I can see it.
Okay, cool. Awesome. Yes. And folks, let me turn on the chat too. Because as I'm going, just feel free to chime in with any comments. And if it's relevant, I'll bring it up. In fact, I'll throw some questions out. The first question for you all is when are you ready to scale? So if you want to just put that in the chat right now. And while you're kind of thinking about that, this is an interesting chart that kind of blew me away. The failure rate of a Series A company, meaning if you measure failure as like it doesn't return the invested capital, 74%. Series B, 74%. Series C, 73%. Is that crazy? I mean, you think this would be de-risked, right? And so statistically speaking, as an ecosystem, I would say we suck at scaling, right? The fact that this is laid out like this. So, and for me, like, as I've studied this across a lot of companies, so since leaving HubSpot, I joined the faculty of the Harvard Business School. I spent a day a week each quarter with a different company, coaching them on building their sales team. I did it at like Asana, I did it at Drift, I did it at Salsify, I did it at Catalan, did it VTS. All these companies are like unicorn pluses. And so I got to see these like patterns of what goes right and wrong. And I personally think this chart, the reason why it's so bad is because of not answering these two questions right. When are you ready to scale and how fast? And so you all are kind of chiming in here, like, when should you scale? So it's like, fine, you're building your product, you got your 4 engineer buddies, you build an MVP, you got like a couple beta customers, it's going well. Some post-seed investor comes in and gives you $2 million. When are you ready to scale? So some folks like, Terry jumped in right away, always. David, product market fit. Andy, product market fit. Frank says scale comes post-growth stage with a repeatable model. Okay, that's interesting. A product market fit, got repeatable model. Happy customer with case study for Dale. All right, so I like the product market fit. That's like pretty common. A bunch of you chimed in with that. So then I'd ask you, like, what's product market fit? And you'd probably all start talking about this. If you want to say what is product market fit, feel free to chime in there, because I think it's a brilliant answer. I think its origination of product market fit goes back to the Lean Startup by Eric Ries, published, I think, in 2005. And Steve Blank was talking a lot about this stuff too. And before that, and some of you probably weren't in entrepreneurship then, we literally sold the product before it was done. We sold vaporware. It was terrible. And Eric Ries and Steve Blank came out with this idea of agile development and involving customers and doing MVPs and doing all this before we scale, which is awesome. We don't scale while we have the idea. And it's like, wait till you have product market fit. But what is product market fit? And when I ask entrepreneurs that, I get 100 different answers, half of which are associated with revenue. And I couldn't disagree more. I think revenue and customers acquisition has nothing to do with product market fit. And it's confused around it. Oh, when we hit $1 million in revenue, we have product market fit. That just means you have market message fit. It just means you can sell it. Like, if you sell ice to Eskimos and they don't need it, you don't have product market fit. You just can sell. Right. So, there's some pretty good answers out there. Like Sean Ellis talks about, like, when you survey your customers and you say, what if your product didn't exist? How unhappy would you be? How disappointed? And if 40% or more say very disappointed, then you have product market fit. I like that probably the most of anything. Anything I've seen, because it's quantitative and because it's based on customer success, happiness, retention. My only issue with it is it's a survey. Like, I just think, like, they may say one thing in a survey and act a different way. They might try to be nice. It's a founder. I don't want to hurt their feelings. So personally, if I were to like quantify product market fit, I would base it on retention, right? Someone like, especially a lot of us, I think, here are in SaaS software, et cetera. And we could talk about how this applies if you're not. But it's like someone bought your product and they used it and they renewed it. They keep buying it. I think that's the strongest signal. The problem is it takes a long time for us to understand retention. Like, some of us are signing like annual contracts. I actually wouldn't do annual contracts in the early stages. We could talk about that if you want. But sometimes we don't know for a year what our real customer retention is, and we don't have that time. We don't have that much time to be like, oh, let's wait a year to see if we have product market fit. And so one thing that I do with a lot of these companies, and now, at stage 2, we invest in these companies and look hard from this lens and help people operationalize this, is to create a leading indicator to retention. So what is it? What can you see in the first month of a customer's experience with your product that if they do this, they'll be with you forever? And if they don't, they're probably going to churn. That's your lead indicator to retention. And that, I think, is a really important metric to know, regardless of how big you are, to be able to operationalize things around that. Okay, so let's talk about what that might be your lead indicator of retention. Like think about what your leading indicator of retention might be. And I use this framework to try to create a little structure around defining it. And it isolates it down to 3 variables. P% of customers do E event and T time. So P, E, and T. Okay, so let's make this real. So Slack, 70% of customers send 2,000 T messages in 30 days. I like that. I like that as a definition of product market fit, much more than $1 million in revenue. Like imagine if the founder of Slack was like, we're sitting around, it's the first year of Slack, and it's like, our first goal as a company is $1 million in revenue. Or our first goal as a company is to get 70% of our customers to send 2,000 team messages in the first month. It's a very different company, I think, that comes out. And would you rather be building a business and scaling a business that has $1 million in revenue, unsure of like what the customer happiness is, or a company that has even 0 revenue, but 70% of the people that try your product send 2,000 team messages every month? And by the way, you're a collaboration software, so that's pretty correlated. Okay, Dropbox, back up your device in an hour. If 85%, HubSpot, if 80% of our customers used 5 or more features within 60 days, right? So that gives you some ideas there. And I think about what yours might be. Okay, so Scott, good question. Lloyd was going to ask this one. What about large enterprises selling big dollar products? Let me kind of hold that for 1 second, Scott, because I want to show you. Let's kind of walk through the rest of this here, which is like, here's how I kind of think about defining the E and the P and the T. The E is the most important. It needs to be instrumentable. It needs to be objective. It's not like a customer success manager said they're good. Ideally, it's aligned with your unique value prop. Like in HubSpot, we were an all-in-one software, so ours was the breadth of the usage, really nice alignment within the organization. Okay, and then here's how I like to measure it. Right, so I measure it in cohorts as defined by the month in which the customer was acquired. So you see here at the top. Let's go back to Slack. This isn't Slack's data, but let's just pretend. 24 customers acquired in January. And this tells us how many of them sent 2,000 team messages every month. In the first month, 3%, bad. Second month, 27%, better, not good. After 6 months, only 39%. That's not good. You're a collaboration software product and only 39% of your customers you acquired 6 months ago are sending 2,000 team messages a month. Ugh. But they made a bunch of changes to the product, the onboarding process, who they sell to, the messaging, and bam, let's look down column number 2, month 2. In October, they acquired 55 customers. By month 2, 70%. Got it. We're sending 2,000 team messages. So I think they hit product market fit right around here. October, November, December, something like that. And this helps us see it as early as possible, okay? All right, so Scott, let's take your question now. So yeah, I got a couple of companies that are selling like ACVs are like 500,000 to $1 million. First off, I don't I don't love starting upstream in a company in an early stage, just because it's so much red tape and such long sales cycles and so capital intensive and such a there's like such a slow learning curve. I'd rather you think about your total addressable market, and sure, it's enticing to close those $1 million deals, but I'd rather you like start as low as possible in your addressable market to get faster data points and to learn. Now, you can't always do that. Like sometimes it's just what you're going after is an enterprise play. Like the one company of ours is, they only sell to like the top insurance carriers. There's like 27 of them, right? So their deals they start at like $500,000 and grow to like 10 million, right? And so when you have a company like that, I think we had like 6 or 7 customers and we were a multi-million-dollar company, right? So you can't do this analysis. But what we did was we created a multi-dimensional leading indicator of retention. It was 5 dimensions. I don't remember all of them, but it was like, how many users did they have in the organization? How high up were we in the C-suite? How many Sev1 support tickets did they do? How quickly did they set up? And how many transactions were processed every month? There was like 5 dimensions of health. And it was like red, yellow, or green. And then that rolled up to a red, yellow, or green for the account. And that's the first slide we looked at the board level. And the board was trained on how to like see things through that lens. So hopefully that's something, Scott, that you can envision. Okay. All right. And then you can like actually test this. So if you're sitting around, you're like, I don't know what mine is, like Slack, right? 2,000 team messages in a month, maybe, right? But like a year later, you can actually analyze it. So in this case, like the company acquired 68 customers a year ago, and 82% are still around. Now, 55 of them had hit that lead indicator retention the first month, and 13 didn't. Of the 55 that did, 93% are still around, and the ones that didn't, only 39% around. Okay, great. This is actually correlated. Like there's a big enough variance in that retention that I'm pretty sure, statistically speaking, that if someone hits this event in the first month, they're going to be around. And if they don't, they won't. We learned something really important about our business. Same data set here, just not correlation, right? 68 customers, 82% around, 55 hit it, 13 didn't. But in this case, 84% of the ones that hit it are around, and 77% of the ones that didn't hit it are around. And that's not a big difference. So that 2,000 team messages isn't right. Did we waste a year? No. It was much better than focusing on revenue. You're focused on customer happiness, retention, success, much better North Star at this point. And now we're in a point where we have enough data, we can actually figure this out in a week. Right? Like we can just analyze it. And maybe it's the number of users, not the number of messages. Maybe it's if they have 10 or more users. Well, we can do the same analysis right now and figure out what's correlated. That's interesting, Frank, on Medic level 1 qualification. I'll have to look at that for correlations there. So that's product market fit. I don't know, Lloyd, if anything came to mind there before we go to the next stage on whether
I think one key thing is you could probably, how far do you break it down? Do you look at what percentage of the people signing up are effectively going through the product onboarding? Because the onboarding has a strong correlation between sign up and retention. And if people don't onboard for the first few weeks, chances are they're dormant. I saw that in my last company, 10,000 users wouldn't go through onboarding. We shut the company. Right?
Yeah, speed to value could be it. That we've seen that. Like we want to see that value. It's a good one. It's a good one to measure. It's just that I also like to come up with something. You could have a different one that's on the onboarding and one that's more longevity, because I want to be able to measure this every week or every month too.
Yeah.
But you're absolutely right. Speed. I'm starting to see like some patterns that there's some that are engagement based, like the Slack example, 2,000 team messages. There's some that are ROI based, like HubSpot's might be like a lift in leads. There's some that are like more just pure setup based, your speed to setup, and that's all that matters. Like oftentimes, like with analytic stuff or processing stuff that's going to happen behind the scenes, that one's correlated. But yeah, it's interesting. Like you almost have to work on a mini case by case example to kind of think them through.
Definitely, right?
Yeah. The other thing I want to say that you said, Lloyd, is percentages, because like segmentation's key here. And I forgot to mention that. It's like, you don't, especially if you're doing a PLG, product-led growth type thing, and like 100 people are coming in the funnel every month. And let's say you say it's like 70% like set it up. That's when you have product market fit. You don't need 70% of the 100, because anyone's coming in. Like 13-year-olds are coming in, and like people in Japan, and like, people, there may not be in your ideal customer profile. It's only the people in a particular segment. So if your North Star is like 70% set this thing up within a week, and of the 100, only 40% set it up, but anyone that works for a B2B tech company in the US, that number is 78%, then you have product market fit. It's just in that segment. And we'll talk about what to do with that. Other questions, Lloyd, before I go on? Or
no, I think this was great.
Cool. All right. So are we ready to scale? I would still say no. I forget who had said it earlier, and it's they said repeatable process. Right. So notice as I was walking through that example, I didn't really say anything about profitability or scalability. In fact, I would I would suggest that you take Paul Graham, the founder of Y Combinator's advice, which is do unscalable things early. I think it's beautiful at the product market fit phase. Like, let's just appreciate how hard it is to come up with a business idea and to get like 70% of your customers to realize that value. Like that's like almost the whole business. You know what I mean? It's like, that is so hard to do. And so throw everything in the kitchen sink at it to do that. Like I tell the example of like David Cancel, he was our chief product officer at HubSpot and then went off as the founder and CEO of Drift. And Drift sold for $1 billion last quarter, and they're still off and running. But you know, what was he doing in the first year of Drift? He was flying pre-COVID, flying to personally onboard as founder CEO customers that were paying him $50 a month. Not scalable, but beautiful behavior at the product market fit phase. Throw everything in the kitchen sink to make that happen. But now once you do, and you've proven that if we put 100 customers into this quarter, 70% are going to succeed and retain, and you know, even lead to even better numbers. Well, now we need to prove that we can do it scalably. And oftentimes we talk about that in terms of unit economics in our world. Why do we do unit economics, not GAAP accounting profitability? Because unit economics isolates the costs that drive growth versus the costs that are more static. Okay, so that's why we focus in there. Now, same thing with retention, right? I'd argue customer retention is the best proxy of product market fit. It takes a long time, so we have to come up with lead indicators of retention. Unit economics is the best proxy of go-to-market fit, but it takes a while. It takes 1 or 2 quarters for it to surface. So we need to understand the lead indicators of good unit economics, and that's just pure algebra. Okay, so let me give you an example. So just going down the bottom here, just reading your comment. So like one way we can measure unit economics is LTV to CAC, right? The LTV to CAC greater than 3. Now, like imagine having like a 27-year-old account executive join your company, and they're like, "What's my job? What's my goal?" Technically, their goal is to create an LTV to CAC greater than 3. But like a 27-year-old account executive doesn't know what to do, right? They know how to make calls, they know how to do demos. So we have to extract that goal back to those activities, right? So LTV, we often talk about the average sales price, ACV, times the gross margin divided by churn, okay? CAC is how much does it cost to get the lead, plus how much does it cost to sell the lead, okay? The cost, the demand gen cost is like the cost per lead divided by the close rate. That's the marketing cost. So if it costs me $100 per lead and I close 100% of them, my marketing cost per customer is $100. But if it costs $100 per lead and I close 10% of them, my marketing cost per customer is $1,000, right? If I extract the sales cost of that customer, it's how much do I pay my rep divided by the number of customers they close each month or each quarter. And the number of customers they close is how many leads do they get times the close rate, or how many leads do they generate themselves times the close rate. So now I've taken that end goal of LTV to CAC and extracted it back to measurable things, and I can create a business model around it, right? So, okay, I think our average selling price is going to be $20,000. I think we can get leads for $1,000 a pop. I think our close rate is going to be 5%. So that's going to spit out a good business, and I can just dashboard it. And so we all have our dashboards, but this is the dashboard that tells us today if we're going to have good unit economics in 6 months, right? So as long as we keep the blue above the red, then we're good. Okay, so yeah, that's my answer to when are you ready to scale? Because I think a lot of people are just, they're not that precise about it. And a lot of the VCs, like, I don't mean to be offensive, but don't help with that. They they give a bunch of money and they're just like, go. So yeah, if you have a question, Matthew, on this, that's that. But that's my what I see in the industry. And I hope that you can appreciate, that like this analysis is not letting some other company's success dictate when you scale because some VC invested in that unicorn and it did well and now they want to replicate it. This is showing you how you use your current company's performance to decide when to scale. So Lloyd, I see the questions coming in. I don't know if like you have one or if there's one that.
No, I think keep going. Keep going.
Okay, cool. All right. Well, that just tells us when to scale. Now, how fast? I don't know if you all want to chime on this. This is always very interesting. Okay, so you're like, so fine. A lot of you are probably in this situation. Like you had your 12 engineers, you built your product, you got to like a couple 100,000 in ARR because of like your introductions from people, and now it's like, okay, here's your Series A. Congratulations, $8 million. We're valuing it like 30 million bucks. Congratulations. And then they're like, all right, well, how much revenue are you going to do next year and the year after? Can you put together a plan? And yeah, Suma, I'll post the slides. So like, how fast do you go? Samim says, as fast as you can maintain the same great customer relationship and experience. I like that a lot. That doesn't happen though, Samim. That doesn't happen. Like, I've never heard someone say that in a board meeting. That's a good answer. Like, I'll tell you, here's how it happens at the board meeting. And this happens to me every quarter. It's triple, double, right? And that's just because the reason all that comes about is because a lot of us raise venture capital and VCs are trying to entice their investors with an attractive IRR. And to get that attractive IRR, their companies have to triple, double. But really only 2 out of the 10 have to, and everyone else fails. And everyone else fails because they weren't ready to triple, double. And that's where the investor and the entrepreneur are misaligned. Because you as the entrepreneur, for your investor, you're one of 20 bets. They kind of just want you to either be a rocket ship or fail fast so they can get off the board, which kind of frustrates me about the ecosystem. Right. So, and this is how it goes. It's like, all right, well, this is the story I hear all the time. So how fast are you going to grow? We're gonna go for 12 million this year. Okay, how much did you do last year? We closed last year at 2 million ARR. Woo, 2 to 12. That would be great. You'd be one of the best companies in the country. So how are you going to do that? And they're like, oh, we're hiring 30 salespeople in January. Seriously, this conversation happens every quarter. Oh, you're hiring 30 salespeople in January? Mm-hmm. How many salespeople do you have right now? 5. How many did you hire last quarter? 1. All right. Do you know how many interviews you have to do to get the 30 hires? Who's doing that? Do you know how many candidates you have to source? Who's training them? Do you know what the average rep to manager ratio is in the industry? 7 to 1. Now you need 3 managers, 4 managers right now. And by the way, how many leads per rep did your reps get last quarter to hit their number? And now you're going to 8x demand gen in a month to feed your reps? If you do that, I want to know your marketing team because they're the best marketing team I've ever seen in my life. That's insane. And they all do it. And I know why. It's because the founder negotiated this like huge valuation and the VC was like, yes. And now the founder's like, oh crap, now I have to do it. And the Excel model says if I hire 30 reps in January, I'll hit my number. And that's the extent of the analysis. Okay. So don't do that. Don't fall into that. And I know a lot of you are sales leaders and probably like, oh my God, I tried to tell my board that. And it's a much bigger story about how you talk people off of it. But think about pace, think about scale, not as one-time hiring upfront like almost everybody does, but as a pace, right? So it almost goes all the way back to Samim's answer, which is brilliant. which is like, you can go as fast as until you break customer success. It's a little bit broader than that. It's the speedometer, right? So like the leading indicator of retention and the leading indicator of unit economics becomes our growth speedometer. It dictates, just like Samim said, how fast we can go. So establish a pace. Great. We're ready to scale. Let's hire 2 reps every other month. Okay. Let's do that for 6 months. And then let's watch the speedometer. If the speedometer stays green, let's do 2 reps a month. Let's do it for 6 months. If it stays green, let's do 4 reps a month. Do that for 6 months. If it stays green, we'll hire 8 reps a month, and congrats, you're a unicorn. And you did it in a very predictable way. And you're watching the speedometer, which is, most of your peers are deciding if they're going too fast or too slow based on the P&L results at the quarterly board meeting. That's BS. The P&L results at the quarterly board meeting, that's what happened 9 months ago. That's a result of the sales calls, the onboarding of customers that we did 9 months ago. The speedometer is what's happening today. This tells us if we're going too fast or too slow. Okay. All right. So now what I want to say is like this. Now, hopefully, we've got a nice picture of, product market fit, then go to market fit, then we're ready to grow. It's all based on our data. We know what phase we're in, and based on our phase, we know what our North Star metrics should be. The other thing this instructs us is it helps us with our go-to-market system design. All right. So if we look at different aspects of the go-to-market system, who are we targeting? What's our sales playbook? Who's on the team? How do we generate demand? What's our pricing model? How do we comp our reps? These all change as we progress through the model. Like the 10th rep you would hire in the growth phase is way different than the first rep. This kind of came from the sales learning curve, also from the early part of the century, published in HBR, I think, for the first time. And they call it like the I don't remember, the Renaissance rep versus the coin operated rep. Okay, and they use more of a manufacturing analogy. I like to kind of modernize a little bit today, where your first rep, like your coin operated rep when you grow, is just like, give me the comp plan, give me the playbook, give me my territory, let me go make a lot of money and make you a lot of money. Great, I like that rep. Terrible first rep. There is no comp plan, there is no sales playbook, and we don't even know who we're targeting. And that rep's just going to go out and show up and throw up to the market and say this isn't working and quit. Right? We need someone as our first rep. That's the first person in our company that's going to talk to 20 to 30 potential customers every week. Woo, that's valuable. That's our whole job, is to talk to customers. And so they need to be like part account executive to be able to progress that sales conversation and talk about money and negotiate, do discovery, et cetera. But they also need to be kind of like part product manager to step back and say, what happened in those 30 calls? Here's the pattern, and let me talk to the engineers about it. They also have to be like part product marketer. What's the messaging that's sticking? They have to be like kind of part CSM, because it would be nice if like they can onboard the customers too. Like they're kind of like a jack of all trades. They're hard to find. Usually where you find them is in your region, if you're New York, San Francisco, or Germany, or wherever you are. If there's a company that's scaling up, now they're at Series A, Series B, they've gone to 10, 100, 200 people. They're usually in that company and they're lost and not happy. They were there when the team was 10. Now the team's scaling and they don't have really an important job. They don't want to be part of the factory, and they like the new stuff, and that's where you find those people. So anyway, at this product market fit phase, we're doing the whole like scale, try to make the customer successful at all costs. So I don't want to talk about scalable demand gen. We should be able to get enough customers through our network. That doesn't scale, but I don't need to talk about setting up a sophisticated cold calling or inbound marketing mechanism at this point. Pricing, I don't care about. I want to price for commitment. I don't care that it's optimized for profit. Free's not good. That's not committed. But 50% off, absolutely. I don't care. Let me have a legit at bat to make this person successful. But that all changes at the go-to-market fit phase. We need a playbook. We need probably 2 or 3 reps with someone who actually knows how to build a process. Right? We need one scalable demand gen mechanism. Because before we start adding reps, we need to be confident we can feed them. And that could be they find their own leads, or it could be we feed them. I don't know. We need one. And we need the pricing model to be right and the comp plan to be right. That drives our CAC. We need to figure that out before we add 5, 10, 15 reps, okay? And then we can move into scale mode. And a whole nother set of issues come up. I'll talk about in a couple of them in a second. But you add it, the go-to-market playbook is reinforced. That's the introduction of your sales management layer. You often have multiple demand gen channels that need to be managed. You have to think about how people grow in the company. Okay. So that's kind of like, not only does the framework help us know where we are and what we should be focused on, it also instructs us what the optimal go-to-market system design is. Any questions there, Lloyd?
No, I think this is good. Keep going.
Okay, cool. So the question is, and feel free, folks, to ask questions. David, above all, and it pushes failure more. There's a lot of agreement. That's great. Thank you. I'm glad it's helping and resonating and where the slides are, et cetera. But yeah, feel free to just post your questions and I can look at those. So the last place we could tackle is, well, where do you scale? And so I mentioned that averages become dangerous. I mentioned that, you could have 100 customers come in and try your product, especially in like PLG. And some of them are like who you intended to build it for, like a director of engineering at a tech company. But some of them could be like I said, like 19-year-old computer science students in New Zealand, right? It's like not really who you build it for. So it's not that you have to get everyone to succeed. You have to pick a segment and make that work, and then you scale that. And that's the green box here. Now, what gets interesting is like you scale up to 3 million, 5 million, 10 million, 15 million. Here's the next big issue that happens. It's like, okay, cool, we're at 10 million, and our investors told us we have to get to 20 million because of their IRR need. And I analyzed right now today, we sell, we sell to the SMB market, we sell our product, our core product, and we sell it through marketing generated leads. So we get like 500 leads a month and we sell those and we've got that down. That's our market product channel combination. We know how to do that. And I actually ran that through the analysis and I grew my lead flow by 5% a month and I added some reps at a good pace. And we grow from 10 million to 16 million with that. And I think we're going to do that. And I personally would buy that. But then we have to grow to 20. So what should we do? I have an idea. Let's build a new product. Or let's go to the enterprise. Let's take that example instead. Well, so then what they say is like, let's hire 3 enterprise reps and tell the board we're going to do 4 million in the enterprise. I don't get that. Like when we were 4 engineers in a room, we didn't say, I have an idea for a product and I'm going to hire salespeople and commit to 4 million. We just had no idea how long it was going to take to get to product market fit and go to market fit. So how come when we're at 10 million in revenue, we think we can just build some new product that's just going to work or change the market and it's just going to work? It doesn't. The messaging is going to be the same. The demand gen tactic is going to be the same. The playbook's going to be different, right? Like it's a different rep. We don't know how to do it. So we have to start over at the product market, go to market fit journey. And we shouldn't pre-commit to revenue before we've tested it and figure it out. So you can do a segmentation of like this market channel product segmentation in each box. And I know it's hard with like cost attribution or revenue attribution. It's not always clean, but take a stab at it. And you can uncover like how much revenue are you doing in each box? What's the churn? What's the unit economics and what are the leading indicators with each? So you can understand which of these boxes are in the growth and moat phase where you can scale and which are not. And for the ones that are not, as CEO founder, you can decide which ones as a company you're going to experiment with to try to move them into the green box and which ones you're going to ignore. Right. So this company has figured out how to sell direct to both the mid-market and the enterprise segment through through a direct channel, their core product. And they're going to, they're going to test out partners, and they're going to test out a new product for the mid-market, right? And so if you don't do this analysis, you're going to be like, all right, everything's working because their LTV to CAC is good, which is what normally they do. Let's add 20 reps this year, and you could accidentally add them in the red boxes. That's what you basically do when you say you're going upstream, but you haven't figured it out. And that just, or even worse, you build a new product, you train all 20 of your salespeople before you figure it out, and it doesn't work. No one builds a product and it just like crushes. It takes a while, a quarter or two for it to work itself out. So now you've decreased the productivity of 20 of your reps foolishly, as opposed to isolating 1 or 2 reps to sell that product, so that they're the only ones that are affected, and they see the patterns quicker because they're doing all the demos with that product. Okay, so there's actually good research on the ambidextrous organization if you want to check that out, by Michael Tushman. So once you know where you are, if you're going to add 20 reps, you only add them to the scaling buckets, and you keep the other buckets just like your company looked like at the seed stage, small cross-functional team to try to figure it out. Okay, so that's how it is on where we go. So John Krim says, how about blitzscaling? Align with lean, data-oriented decisions, healthy, smart growth versus growth at any cost. How do you reconcile this approach with blitzscaling? Okay, yeah, Chris Yu's a good buddy. And Reid Hoffman's obviously a legend. And I think I perceive their work as like, those that go out and raise the most money and make the biggest PR and get out ahead of the category and hire the best engineers, regardless of like optimal profitability and stuff, will win. Okay. I think there's definitely like merit to that. I personally think like if you think about their backgrounds, like Reid and Chris, like they came from LinkedIn, right? Reid was the founder of LinkedIn. So they tend to be in more of like a social network type of business where it is heavy network effects with winner take all dynamics. So I just, sometimes I'm a little like totally agree in that context, but not as much in some of the traditional software plays. The other thing that I'm concerned about is just where's the line on unhealthy growth, right? Blitzscaling is kind of like raise a ton of money, hire a ton of people, don't worry about profits, just burn money and go. But like, what does that mean? Like, are you willing to burn $10 billion a month, $10 million a month? Are you willing to burn $100 million a month? Probably not. Like oftentimes we'll have between $500,000 and $1 million. So like, don't confuse this like framework as an argument to go slower. It's just to like go really fast up the right tree at the right time. That's all it means. Because if you're going to skip, go ahead, Lloyd. Yeah.
We had Chris Ye. He ran a similar masterclass.
Nice.
And there's a bunch of similarities. I think they're saying sort of prioritize speed over efficiency if you're in a market that's winner take all. Yep. Right. And but some of the things like product market fit and what you prioritize, doing things that don't scale, figuring out one repeatable, scalable channel, and then go all in and trying to prioritize what sort of fire you put out or what thing you de-risk. You got to prioritize at each stage. So there's a lot of similarities in there as well. I think we shouldn't look at blitzscaling the audience here and just assume that, hey, you know what, we're going to raise lots of money and then just go boom or bust kind of thing, right? Ultimately, not everyone can raise that kind of money. Not everyone's in a winner take all market. And so, having a lean approach to product market fit, go to market fit, and then scale is the way to go. But there's a lot of similarities.
Yeah, I think maybe the title is a bit surface, blitz scaling. You feel like just go. And there is some to that, right? But it's like, and it's like, and it's also like, hey, listen, I'm taking a pretty rigid stance on getting health and everything. You're not going to get these speedometers perfect before you go. Like you're not going to just, you know what I mean? It's like direction, they're moving in the right direction. You need to instrument it and you need to see like when it goes into red alert. If you set up the speedometer, you'll catch that red alert instance 2 quarters ahead of your peers. But it's not like there's certainly a compromise. And I also think like Chris and Reed, if like they misinterpreted their work and someone was like, just spend money, don't worry. Like, no, that's not what we mean. You know what I mean? It's like, yeah, I try to get ahead of it, but there's certain lines there.
Definitely.
I see Suma's question. Did you have one, Lloyd?
No, I was just asking if you're near the end of the slide, should we move to pure Q&A or?
Yeah. I'm at the end. I'm done.
Cool. So I've few questions here, and leave the slide. Who do you hire in each of those stages, right? What does your company look like? Because you made that journey at HubSpot, product market fit, go to market fit, and growth and moat. Who are the key people to bring on at each of those stages?
Yeah. So the first one, that's that athlete. You probably have one, honestly. Like I think at the product market fit phase, this could, depending on how much money you raised and like what you're going after. But I think in general, you have a handful of engineers, a product manager, a designer, depending on your product, et cetera. It's very much an R&D team. And then you have like one go-to-market person who again is like, they're just out there, they're talking to like 10, 20, 30 customers a week. They're doing deep discovery calls because what you think is out there is probably not and so they're learning where the market opportunity truly is. And I like to run a daily film review in that context where this person might have 2 or 3 customer calls a day and they'll use something like gone.io and have those calls recorded. And then I like to get the whole team, like the whole team might be like 10 or 12 people. I like to get them all in a room between 5 and 6 at night and listen to the call. And you do that every night. God, 1 month, you've done 20 customer calls and you kind of sit back and talk about where's the opportunity? Are we building the right spot? Are we messaging this thing right? Et cetera. So that's kind of like my team there. Then it's like, okay, great. We have product market fit. We know that when we add 10 customers in, most of them like our product, succeed in our product and retain. Now we're at go-to-market fit. So now I need someone to build a sales process. I need someone to codify it. I also need a marketing, a demand gen approach. So it's either I hire a content marketer if I'm going to lean in that way. I kind of like to start there. It tends to be pretty scalable. Or I hire like an SDR, right, and try to get or 2 SDRs, try to get the cold calling mechanism going. I probably have like 2 or 3 reps at this point because I'm hoping that I don't have a single point of failure on that. Because like if I only have 1 rep and they need to put up 700,000 ARR a year for the math to work. And so that's basically what, 60,000 ARR a month. And they only do 30. Well, is that the rep or is that the playbook or what is that? Versus if I have 2 or 3 reps and one does 65 and one does 50 and one does 25, well, at least I know it's achievable. And I can tune my rep a little bit. So yeah, that's pretty much what it looks like there. Probably 2 or 3 reps, someone could build a process. You may have a sales manager at that point if they're going to build the process, and you might have either a content marketer or a couple SDRs. You definitely have a CSM at this point as well. That's partitioned out. And then, once you get up to the growth and moat, I mean, that just goes, right? There's always a question about do we have SDRs that feed AEs that feed CSMs? That's in vogue these days, but it's not always applicable. But you might have that. You have a management layer, et cetera.
At what point do you bring on a sales leader, and what does that sales leader do in the first 1 to 3, 5 months? And what are the key traits of a great sales leader?
Yeah. So on the homepage of Stage 2 Capital, Mandy Cole, one of our partners, and I wrote a little ebook on hiring your first sales leader. So we wrote there's a whole bunch of information in there on what you should be looking for, how you assess for that, interview questions you might ask to understand that. So for me, the first one, it depends, Lloyd, whether a good playbook is in place or not. If you've got a great sales enablement person and the playbook's humming, or an early rep who has a great playbook, then playbook development's off the table. So it just depends, do we need playbook development or not? And that might be almost always the case in sales. The first sales leaders, they need to be able to build in the methodology and a playbook. But other than that, what I really look hard at in any sales leader hire is their ability, just like we said before, hire and coach. Their ability to hire and coach. I don't actually care that much about like, can they design a good comp plan? Can they do a good territory analysis? Can they put together an annual plan? Because like we can find an advisor to help them with that. You know what I mean? But I can't have an outside advisor help them like every day hire and coach their team. It's just like, that's just too, it doesn't scale. Like that's what they have to do all day. So that's really what I look at is like, tell me what you look for in a rep and how do you assess for it? A good answer is I don't really care what they say, honestly. It's just like it's thorough. It's like I look for coachability and curiosity and I do a role play and this is what I look for and this is what a good answer and this is what a bad answer. A bad answer is like I know success when I see one, or I just go back to my Rolodex of people I've worked with, or I look for someone with 10 years experience in my industry. Those are really bad answers. When I coaching, right? Like, can you tell me common skill deficiencies you see in your salespeople and how you coach people through that? If they stumble, it means they don't coach. If they're like, oh, it's always sense of urgency development. I do role plays around, how to dive into the implications of need. And I'm like, beautiful. This is a good coach. Ooh.
Question here in the GTM stage, how do you figure out the one scalable, measurable medium, especially when hiring, or like there's so many channels? How do you figure out?
I know. It's you have to start with your buyer. Like what is how does your buyer live? What works for them, right? So you're selling to engineers, cold calling doesn't work. Engineers don't have phones. And they don't even like to go on their email. Engineers, PLG is beautiful. They love to try stuff, right? You're selling to CEOs, PLG is not going to work. They don't have time. They don't have a computer. They have 3 assistants. But like selling to CEOs of big companies, your demand gen channel is going to be like steak dinners and like thought leadership, small peer group workshops to get people together, right? So it really depends on your target buyer. The most common ones are, content marketing. It still works today. There's a lot of examples. You just have to really carve out your unique messaging. Cold calling, cold emailing. Those are the ones that people lean into. If you have a product led growth model, you could add virality to that as well, which works beautifully. But those are typically the common ones to start.
A couple of questions here around like, when do you go global, which is probably the similar metric of measurement like we talked about. Like when do you go global versus new product versus going up market, right? And you gotta, it's probably similar things because you're gonna go through that same journey of
you do have
going
to
global.
go through it. Yeah, you do. That's changing the market, right? My argument is anytime you change the market, product, or channel, right? Channel being like you got to 5 million through inbound marketing. Now you want to add cold calling. You got to test that out. It's going to be new. You got to get the unit economics to work. So it's hard. Like when do you go global, Lloyd? That's so hard versus build a new product. It's so contextual, right? It's like it means like what's the competition doing? Where's the biggest opportunity? Like I don't know how to answer that other than when you hit like 10 million in revenue, and we're doing this with a bunch of our companies now, you want to build a new cadence internally where you are experimenting and scaling at the same time. So you actually have an experimentation funnel that leads to growth opportunities. So for example, like if you're sitting here and saying, I don't know, should we build a new product or should we go international? I wouldn't suggest like choosing one and going all in per se, unless it's like a must do or die situation because some competitors eating your lunch. I would argue, how can we test if that new product has legs with as few investment in as little time as possible? Can we build an MVP and see what the demand is? And international, our first toe dip in to international HubSpot was we had 2 reps. They happened to be new dads that called into Europe from Boston. That was our dip into international. It wasn't flying out there, open up a whole office, hiring a whole team. It was 2 reps that we knew could sell in the US. We said, now sell to the European leads. They worked from 4 a.m. to noon, and they loved it because they had newborn at home. So they left at noon, and the newborn was up at 4 a.m. anyway. And we did that for a year. And so by the time we were going into Europe, we knew how the message was different. We had a lot of confidence on it. So usually there's a way to test these things as opposed to having to go all in.
Now, question here on how does the process of assessing disruption risk for pricing work? HubSpot's price changed over time,
oh my
right?
God.
And then you guys defined a whole new category, but once you defined the category, lots of entrants came in.
Yeah.
How do you assess disruption risk?
Yeah, so the pothole there is raising the opening price can be dangerous unless you have a sustainable moat. That's a mouthful right there. Sustainable moat is its own lecture. It's like, I guess we have to start there. Is you read Michael Porter, his work from the 70s on Porter's 5 forces, and read about barriers to entry. He nailed it in terms of a true sustainable moat. And you can translate, if you look at my my SaaStr speech from this fall, I did a whole slide on it to translate it into modern times. But
what is the cliff notes on that? What are the
real quick, it's just like, like normally when I talk to entrepreneurs, I'm like, what's your moat? I'm like, oh, we have this feature. Okay. Like, how long would it take the competition to build a feature? 3 months. Fine. That's not a sustainable moat. So like the lens I want to have is, imagine if like 5 rock star engineers from Google quit Google and raised like $10 million from Sequoia and basically downloaded your product, reverse engineered it, and built it and sold it for half the price. Why do you still win? Okay. Well, there's reasons why. Like Salesforce still wins because they've trained a lot of reps on how to use their product. They have an ecosystem of apps, which creates a network effect. And initially they owned the end of like kill software relative to other folks that was hard for the incumbents to move to. HubSpot won, like plenty of people reverse engineered our product and built it and sold it for half the price. And we still won. Why? Because people were not necessarily buying like clicks and widgets, they were buying inbound marketing. And if they were going to do inbound marketing, they wanted to do it the best, and they were willing to pay twice as much for that. So that's almost like category creation, the modern version of brand. Gone. Why would we pay more for Gone than maybe Chorus or a new startup? Well, like Gone has a machine learning algorithm that has processed 10 billion sales calls. So what do you want? Do you want the cheap one that's only processed 100,000 and isn't that accurate? Or do you want the one that's the Rolls Royce for your sales team so it can guide you on the best practices based on 10 billion sales calls? That's a machine learning, almost like an economies of scale type sustainability. So you need, like, if you're going to increase your price, you need a defensible moat. Now, the problem that I often see is people launch, do well, they're the first to market, first in the category, they don't have a sustainable moat, and the board's like, hey, why don't you double your price? And it works. The reps love it. It's like, shit, now, like, I used to close 5 customers a month for, $500,000 now, or $100,000. Now I close 5 customers a month for $200,000 just because we doubled the price. And all that does is make you a more attractive attack from competition. Like, how do you go after, like, that's why I love PLG. Like, how do you disrupt like Slack when you can just download Slack for free?
Yeah, and that's what a few themes I heard there is ecosystem, community, which HubSpot did. You guys build a community. And I said at the start, if you build a community, you won't become a commodity. You're creating a category there. And you talked about network effects, right? And
so that's a whole
PLG
piece,
is
Lloyd.
huge.
Yeah, that's a whole piece, Lloyd, of like, that's like, what is the true sustainable moat? That's one piece of it. And another piece is be very careful of increasing your opening price because it just makes you a more attractive, disruptive target by the competition. I'd rather see you increase your expansion price. Let people decrease the friction of someone to use your product for the first time. And once you achieve success, drive ACV by selling them more stuff. Okay. So just be careful on that.
Couple of questions I want to take.
I do have to, maybe just one more if I could, Lloyd. I got to jump on another call. Sorry. Yeah.
Okay, one more. So any guidance on sort of how much do you spend on marketing, content driven lead gen, like the inbound stuff versus inside sales, SDR lead gen?
Yes. No guidance. It's like, it's all over the place. And it's kind of like, what do you want to be? Like Salesforce is in a very like event marketing driven organization with driving a lot of their revenue through account management, cross-selling products into their customer base. Okay. So they're like how much they spend on event marketing versus cold calling versus account management is all based on that strategy. In the early days of HubSpot, I think we were probably like 1/3 of our CAC was on marketing, and that was pretty much all content marketing. And 2/3 of our CAC was on the sales piece, on selling. Over time, we tested a cold call and SDR, and as that worked and we had growth mechanisms, that crept up to be a bigger piece. Compare that to maybe like a Workday that was selling into big HR companies that maybe didn't take as much of a content marketing play, but was purely cold calling SDRs. They're going to have a much bigger spend, right? So I can't give you like spend 1/3 on marketing and 2/3 on sales versus 10% on marketing versus 90% on sales. It depends on like your market opportunity, your buyer. It really does.
As a founder who's recently been in some of these people's shoes, I would say you can get to 10 million ARR by focusing on one kind of customer coming through one kind of channel, getting one kind of value, and you shouldn't distract. Like everything we did was through traction community. Our investors came through this. We hired 100 people through this. We got all our customers through it. We just copied the HubSpot playbook, but we were bootstrapped. So we hosted a lot of events. And then we had SDRs calling post-event. And that worked really well to a point.
You're spot on, Lloyd. It's like, because we get confused because we go out and raise money and then the investor's like, well, how do you get to $1 billion, right? Because they look for like a big market and they have to invest in big markets, but don't confuse that with your $0 to $50 million journey. Like if you have product market fit in this smaller market segment that's going to get you to 30 million, great, exploit it, do it, and run experiments over those years to find the new growth opportunities that get you to the $1 billion. But like disassociate your visionary story for the investors from the tactical execution you have to do this year.
Yeah, and what I found worked really well is, at scale now, we're spending 75% of our time scaling what works, right? More SDRs, more AEs, because that worked, more events, podcasts, all of this stuff that got us here, and experimenting with a small team 25% of the time. And if we get to product market fit there, then we go through that same journey again. So that's the playbook. We've followed you since the first conference when you came to Banff. Thank you so much. What a delight.
Yeah, Mark. You bet, Lloyd.
Stay in touch.
Thanks for having me on. Take care, everyone. Bye.
I need some traction.